You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. His website, institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim. This must be Friday. We're talking.
Yes, and people hopefully are listening. The markets, a big short squeeze is causing the action we're seeing right now.
Oh, yeah. Well, of course, you came down into January, February with some really severe downdrafts in commodities, in stocks, in junk bonds. It wasn't a happy start to the year, and then, of course, we had rallies in basic commodities, including crude oil, out to around March, and this is where we are now. So the environment turned positive, and of course, on the first few weeks of that, you'd get some pretty good short squeezes going on, and it continued. You had very good performance out of the base metals and the base metal mining stocks. They really flew, and we'll discuss the gold later on, but they did very well. And then you had things up and starting to get a bit sideways, and I think they must be looking at some weakening business or economic numbers in Europe, because a couple of days ago, the head of the European Central Bank, Mario Draghi, came out with the whole bazooka of stimulus, a huge move, and acting as he's been promising for the last while to do anything to prevent a contraction. And this is now getting absurd. So the first move, or the announcement, and you had a huge rally in the euro and a huge rally in stocks, and then he thought, I guess I've overdone it. So then he said something about this would be the last such policy move, and markets went the other way. And then probably that was too much, so then they've gone back to being positive. And but basically, let's just look at what's going on here. You've got the junk bonds rallying well. You've got basic commodities have moved up into our target month of March, and crude oil is moving up. We had a target something like 34 to 36, but it's continued on up to 38, getting somewhat overbought. So, but this week is got not just the fun of rallying beat up sectors, but also news that really galvanized a lot of the troops. So the news part may be maxing out here now, and then we just go back to maybe we can have a market not too pushed by news items and just allow itself to somewhere in the next few weeks top out here. Because underneath it, there's you have a problem of far too much debt, and the policymakers figure that more debt will help. So, and I know that back to the 1600s, the theory first came out in a financial collapse in Europe and England, and started in 1618, and then a otherwise tame intellectual by the name of Misselden took a look at things and said that the hardship, you get one of these contractions, and even in those times, employment goes up and there's hardship, and he felt compelled to do something about it and came out with a theory that more credit out of somewhere would make a problem that's due to too much credit go away. Then again, in 1710, the banker in France, John Law, came up with this same theory that if you create more credit, it'll make a credit problem go away. Then that was repeated again in 1873 by the very esteemed editor of The Economist in London, Walter Bagehot, when he wrote that when there's times of stress in the market, if the Bank of England discounts liberally, all will be well. That was published in his book Lombard Street, which was published in 1873, which happened to be the top of that bubble, and it went into a 20-year depression, even though people knew about easing credit. And then in the 1930s, after the bust, or during the bust, Keynes came up with the same theory. More credit will help a problem with too much credit. And basically, his ideas have been more or less practiced ever since. And this is where you've ended up with a century of currency depression, fabulously speculative financial markets, and commodity markets and stock markets. But nothing's changed. You had great booms and busts in the previous century, a big boom in commodities whereby people hoard hard assets, and boom, that got blown out in 1920. And then that set up the next great game, which was financial assets, and then people end up hoarding financial assets until it crashed, as in 1930. And then they hoard cash. So this is where we're here in that point, but with distortions that people can only speculate for so long. Things get overbought and want to come down, and then the policymakers won't, well, at least they think they can prevent things from coming down, and you're into wild market conditions. But after, you had junk bonds peak out in June of 2014 and then really turned bad in June last year, you had the stock market peak in May and has been drifting down into what we call a bear market. So the financial assets aren't going up anymore. But what is happening is the usual. The individuals turn to hoarding cash. And at the same time, the policymakers are thinking that, this is the reason why our theories aren't working, where they put stimulus in and they get business up. But what's been happening was that they put stimulus in and you got stock speculation and you got bond speculation, but you didn't get huge business activity. So then they've gone to negative interest rates, hoping to make their theories work, hoping that people will stop hoarding cash. But then, as you were saying, in Japan, they're suffering that, and people are just putting the money under the mattress, just keeping it, which is giving you a zero return, which is better than parking it in some institution for a negative return. But this really is a form of fanaticism where the same old theory that's been around since the early 1600s, that when you have a problem in credit markets, it's due to having too much credit around, and then they go and figure that more credit will fix the problem. So we'll see. This one should be buried in a year or so, I would guess.
Well, if more credit was the solution to the credit problem, Canada must be in great shape, because our Canadian debt to income ratio has reached a record high of 165.4%. We must be just rolling in the dough.
Oh, yeah. I mean, you think your prosperity would be more widespread. And, of course, a lot of the debt burden goes back to previous Liberal governments federally, and here you got them come in again. And the Harper government was attempting to return to the concept of limited government, and the opposition to that went around saying it was austerity, and we're back to, well, let's use an old one. They're spending like drunken sailors, and they are drunken sailors. And there's very little that, well, many of the media don't want to do anything about it because, as they said, Canada is back. But at some point, there will be enough asset prices going down so that the central bankers are prevented from being reckless, and they certainly are not going to get the religion willingly, they will be bludgeoned into responsibility. The public will demand it at some point, because all of this speculation and theories and central bank practices is ultimately got to be covered by the taxpayer, who is involuntary in the whole thing. It's just nothing you seem to be able to bring responsibility into government circles where they should be responsible all the way around and accountable, but it's not. It's just one big party in expanding the influence of bureaucrats.
We'll have more with Bob Hoye right after the break.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, the International Energy Association says we may have seen the bottom in oil prices. Anything to that?
Oh, yeah, that was a good bottom. You go back to 2014 when we were looking for crude oil to rally up to whatever it would get to by about June that year, and then it would head down, and we had a target, two targets. The crude would fall to one-third of its high, which turned out to be 37, or maybe under severe condition would fall to one-quarter, which turned out to be 27, and that was not real tight technical analysis, but it did come down to 27, and it set that low seasonally in January, and it's now on a seasonal rebound, which we guess this one would go out to March and getting overdone, but I think you have what our theory was had nothing to do with Saudis or peak oil or anything else. It was just that, and it was led by natural gas, new production techniques, fracking, and so the crude would fall into a new low price regime, as instructed by the previous crash in natural gas. It was a no-brainer. And but you had long history of oil analysts watching the Middle East and then hypothecating each distress into higher prices. But eventually there was so much production outside of the Middle East that that game could no longer be played. So I think the rebound has been very good, 27 to 38. Hey, this is terrific. We'll watch for it to get overbought in a season when it can get overbought, and then we'll move out of it. But to consider that crude is going to go back to say anywhere $60, $70, or $80, I think seems improbable in this new but old post-bubble crash world we're in. So I don't see that. It's the same thing. You don't have as much compulsion on the base metals, but one of the big bounces out of that, you had a terrific rally in iron ore prices, which was one of the earlier ones to roll over in 2014, and then all went down to exceptional low prices because there had been a whole lot of financial engineering going on in China over some key leading commodities like iron ore and copper. So these went into free fall, and then the rally with this thing. So actually, iron ore prices ended up being one of the biggest gainers and a leading item. And so again, that was likely to go up into March. And just this week, we got in our proprietary model upside exhaustion readings on iron ore, along with a sequential cell signal, which is pattern. So it's kind of nice to get a momentum signal or a momentum accomplished, and then you're within a pattern that says topping. You get the two together fairly confident. So then the only thing you're not really sure of is it going to happen tomorrow or next week or the week after? But that sort of thing, Tom, Jim, it'll be the pudding is baked, and we just have to see what happens to it here. But when you get that kind of momentum and pattern, it's the result, which will be a rolling over and probably back down to the lows of that 27 again.
I've noticed copper prices over just the last few weeks have made a tremendous gain. Is this an indication that perhaps the world's economy is not as bad as many say it is?
No, I think it's just a technical thing. Everybody was short. It was in a severe decline, and you've had a rebound within a seasonal period. So I don't think it'll last too long from now. Again, these are overbought, been terrific, and looking for a correction. And a sector that did very well has been the precious metal side, particularly gold. And the gold shares, some gold indexes, GDXJ, like up 70% from the low. This is very nice, but it's getting overbought, and our advice is to take a little money off the table on the gold sector and definitely take some money off the table in the base metal side. The thing that is interesting within the precious metal side is that silver has not rallied as well as gold has, and the gold-silver ratio has gone up to a new high. And historically, when you're in developing problems in the credit markets, silver will underperform gold. So this is the explanation. So this is why in the precious metal sector, we've essentially covered gold, and we think that trading gold in U.S. dollars or any currency is just trading currency. I think people should own some gold as an insurance policy and forget about the price of it. And then where currencies have gone down, gold's done well, but where you're in the senior currency like the U.S. dollar, it hasn't done so well, other than the recent rally. And so the idea is to look at gold shares as an investment, because in a post-bubble deflation, and where you've got weak commodities, weak wages, the gold mining sector does well, because typically the real price of gold goes up in a post-bubble deflation, and this has been happening. So longer term, we like the gold sector. There could be a bit of a setback in here in the next short while.
Now, gold, of course, people are talking about, is getting a lot of attention. Will gold end up being oversold and perhaps drop in price in the near future?
Yeah, there's going to be some trades in gold itself here, but that's, as I say, a currency play, and I like the investment side for gold miners. So,
Bob, thanks a lot for chatting with us.
Always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward any questions or comments to info@HowStreet.com and check out our popular YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.